session 3.2, which you'll find in Module 4, which is all about financial reporting basics. This one is about cash versus accrual accounting. You already know a lot about this, so let's review. We're going to spend today talking about cash and accrual accounting and the differences. Last time we talked about the conceptual framework, and that conceptual framework is based on accrual accounting. And accrual accounting is all about revenue recognition, and you recognize revenue when you earn it, and you recognize the expenses that it took to generate that revenue. Well, cash basis. You and I are very comfortable with cash basis because it's primarily used by us and small businesses, but it's not permitted for U.S. GAAP or for corporate reporting. So thus, that's why, because we spend so much time on corporations, we're all about accrual accounting. Now we know that under cash basis, you and I recognize revenue in the period when the cash is received, and we recognize expenses in the period when the cash is paid or dispersed. And on the cash basis, our income statement shows cash received as revenue and cash expenses. We know that we can approximate this on our statement of cash flows if we look at cash from operations. Accrual accounting, though, is what corporations are required to use for the most part. They time their revenue and expense recognition differently. They look at it when it's earned and expenses are incurred and has nothing to do with the cash flow. So accrual accounting statement of cash flow helps us reconcile cash versus accrual accounting. Here's a problem where it's basically CSI accounting, and we're going to do it for insurance, supplies, and rent, and find the missing numbers. So let's start. Here we have prepaid insurance. It's a brand new company, so the beginning balance is 0, and it tells us that prepaid insurance ended the period with, we don't know. We have to figure it out. But we do know that insurance that was paid during the period is $29,000. And we also know that the insurance expense is $20,000. So if I find the difference, I can see that I end up with an asset that has future potential value of $9,000 on the balance sheet. And on the income statement, we'll show $20,000 in insurance expense, even though we paid $29,000. Well, let's take a look at the next one. Supplies. Tells us that supplies expense, or the supplies used, were $11,000, and that the supplies that we purchased during the period were $27,000. We know it's a brand new company, so beginning balance is 0. So it means that on the balance sheet, we're going to show ending supplies having future potential value of $16,000, but on the income statement, we're going to show an expense, meaning used, of $11,000. Notice nothing to do with cash paid. It all has to do with supplies used. Well, the last one is rent. So what we see about rent is that the rent expense is $14,000, we can see that, and that we paid $8,000 in rent. Now, rent payable is a liability account, and I know it had a beginning balance of 0, that we've used $14,000, but we've only paid $8,000 in cash. So we must owe still $6,000 of rent. So we still owe the landlord. So to recap, accrual accounting revenues, they have to be realized or realizable, and the transaction needs to be substantially completed, meaning at the point of either the title passing or the bundle of services that are related to that revenue have been fulfilled. So each and every one of them. So we also realize that revenues are realizable when they're viable and there's a measurable claim to the cash to be acquired. So a viable one means that the customer is good for it. So the actual cash receipt is not required for revenue to be recognized. In many cases, the receipt of cash is something that happens in the future. It could be something that happened in the past. It could be happening at the time of the revenue recognition. So cash has nothing to do with the accrual of revenues or the recognition of revenues. To look at expenses, an expense is an expired or used cost that has no future benefit. And so that expense then goes on the income statement because it's been used or consumed, and the expense is recognized. With accruals and deferrals, do you remember our adjusting entries? Yeah, that was where we had to recognize an expense now, but we'd pay it later. Or we'd receive it later, but it's revenue now. So those are the ones we made those adjusting journal entries for. Those are the accruals. And then we had the deferrals, where we cruised through the asset and liability accounts and said, you know, we've already recognized this as having either future potential value or a promise I've made to somebody else, but have some of those things occurred that we've used and consumed them, assets need to be moved to expenses, or are they liabilities and I've fulfilled my promises and they can move to revenues. So those are examples there. So on the accrual-based income statement, cash can happen before, at the same time, or after the revenue is recognized. On the accrual income statement, your expenses can be paid in cash before, at the same time, or after you recognize the use or consumption of that expense. When I look at the balance sheet, we know that assets on the balance sheet are something that have future or potential value, and they may be future expenses. They could be past revenues, like accounts receivable, and liabilities can be future promises that I'm going to do. They can be past expenses, like accounts payable. They can be future revenues, deferred or unearned. So as you can see, we have to think about when is cash being impacted, and when should I recognize that revenue and expense for accrual accounting purposes, when it's earned or when it's been used.